You're with us here on Bazaar Open Exchange. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. And of course, we are counting down to the pre-open session, which is about 2 minutes away. You know, I want to just take a quick look at the IT services pack. And there is some read-through maybe from what has happened overnight in the US. Not directly, but I think it warrants a quick mention. So there's a company called CDW, which reported earnings. I'll get to the company earnings in just a bit. But this is basically what stocks, US IT hardware stocks did last night. Look at that. Cisco was down 4.5%. HP was down 5%. A company called Pure Storage was down 6%. Anything between 3 and 6% cuts across the IT hardware space last night. Now, the trigger was that CDW, which is primarily a hardware company. I mean, they make everything basically: power adapters, screen guards, microprocessors, motherboards, but they also do services and they offer IT solutions as well. So primarily hardware, but also services and solutions. They came out with a pre-quarterly update and it was pretty disappointing. They are basically now saying that according to them, their assessment, overall US IT spending in 2023 is going to fall in the high single digits. Now, that's not great news, is it? That's their assessment. The previous assessment a couple of months back was that it will be flat in 23 compared to 2022. The stock itself ended about 13.5%. And of course, I showed you the collateral damage we've seen elsewhere. Now, the read-through, as I said, is largely hardware. But, the fear is that the weakness is spreading out of hardware to software as well. Having said that, it is not as if we don't know that IT services itself is under a bit of pressure and there is a slowdown, there are concerns about spending, degrowth, etc. But I think this is one more thing which points to the fact that 23 perhaps will be a tough year for IT services spending, perhaps a rebound only next year. For stocks, the way to look at this is you got to ask whether this is a new signal, new demand weakness signal, or some of this is already in the price after what we've seen with Infosys, TCS, etc. Let me actually put this to Deepan quickly. Deepan, you did allude to this briefly to my question on Mastech, but any thoughts here?
No, I think that the bad news in the IT industry is just about starting to come. I think until about last quarter, all the managements were confident that they would sail through the economic headwinds in the key markets. But the picture certainly is getting ugly. And as I said earlier, I think this particular time we will see the men being separated from the boys. And if the companies which have got good clients, specific verticals, some IP, something special about them, they may continue to sustain growth rates. Some large project could be, but a vast majority of IT companies are going to find the environment very challenging. And you should factor in flattish to slightly declining earnings as well. And how long that could last is anybody's guess, because this entire inflation interest rate situation is not seeming to be ending in a hurry.
All right. Deepan, what about steel? Normally you stay away from these metal stocks in the past for the last many years that I have known you. But what's your view? I mean, some on the street believe that after that lull that we have seen, maybe some of these stocks are presenting an opportunity, though. You need to highlight that there are still plenty of uncertainties with regard to the globe, even for the European market with regard to Tata Steel. But would you look to buy any of them?
I think when you are buying commodities, you're basically trying to fight all the central bankers in the world who want to get inflation under control at any cost, be it even at the cost of slowing economies and tolerating some amount of unemployment. And if you're in that situation, then how can you expect commodity prices to rally or even sustain themselves, or that for that matter, volumes also to grow or even maintain the present levels? So I think it's a very challenging environment. You may have an odd good quarter or so, a new expansion plan going on stream, maybe higher volume here or there. But overall sentiment in commodities is going to be down. And even though these companies may report decent to slightly higher earnings, I expect next 3-4 quarters for them to see a compression of their price to earnings, price to book. And steel in specific is not really trading at underwater type of valuations, which it has done in the past, which make it extremely attractive. They are still at reasonable valuations. So keeping that in mind, I still want to avoid steel. It's better to go for the steel consumers, the real estate companies, the infrastructure companies, engineering, capital goods. I think they are in the best time of their life at this point of time, and that's where one should focus on.
Okay, all right. I do want your thoughts on the pharmaceutical space as well, because they've been a lot of big moves, right, in terms of individual stocks. And of course, we were just discussing that Mankind Pharma IPO too. But let's deep dive into this space now. We have Param Desai, who's a research analyst at Prabhudas Lilladher, who joins in to give us his view. Param, hi, good morning, and thanks for joining us. You know, there is an EBITDA growth or a margin operational improvement that we're expecting for the sector this time around, largely led by a good domestic growth, and, you know, across the board also, perhaps pricing pressure has eased a bit. But you tell us your recommendations on this space and which are the stocks that you like?
Yeah, good morning. So yeah, there is an expectation that the prices have bottomed out in the US market, and this is in our assessment partly also due to the expectation that there has been an increased FDA scrutiny in the on the various plants, which has resulted in various warning letter and import to the multiple generic guys. So buyers in the US are largely looking for an assured supply rather than the lower pricing. So that's one of the reasons which will partly benefit to some of the guys where the plants are largely FDA compliant. So from a Q4 perspective, yes, due to the steady domestic growth, there has been reasonably good new launches like Revlimid, which will aid the EBITDA growth on a YOY basis. Plus, there has been INR weakness of around 10% YOY, which would also aid the EBITDA growth of around 20% for our coverage areas in the Q4.
All right. Hi, good morning, Param. Param, a few of these stocks, they got completely bombed out and now they're recovering. To name a few, Divi's Laboratory, Gland Pharma, as well as Piramal Pharma. From the top, they've seen a sharp correction. Now, if I just plot the margin chart as well, the margins have got compressed. The hope is that things start turning around from here. Your view on any of these three companies, and do you believe that margins will improve? If yes, to what levels?
Yeah, so we covered Divi's, so I will be able to comment on that stock. So Q3, Divi's result had taken a sharp hit on the margin side, largely due to the lower margin contribution from their CDMO business, and also due to the high raw material price inflation. In our assessment, the gross margins, what Divi's have reported around 56-50, that was the lowest since FY12. We do not extrapolate to that, as some of the things have started easing down, and specifically on the raw material side. So the benefit of that will be start getting visible from the Q4. So we do believe that there will be sequential improvement in the names like Divi's. Along with that, they are coming up with a high COVID base. So now I think the last 2 quarters also, I think the numbers are largely reflect their base business, and they have a reasonably good pipeline on the CDMO as well as on the generic API side. So there will be a sequential improvement in the names like Divi's from here on.
Okay, sequential improvement in names like Divi's. Got that. I wanted your thoughts also on a couple of these hospital companies, the likes of Apollo Hospitals. Do you have a buy on that? There's, of course, lots happening here with the expectation of the deal coming through as well. But you tell us, how will the growth look this time around? There has been a lot of competition in this space too. Are you expecting any EPS upgrades here? And on Apollo particularly, what are the triggers?
Right. So Q4 generally seasonally is a strong quarter for the hospital companies. There will be some sequential improvement in the occupancy across the hospital names, which will be reflected even in case of Apollo. Apollo X of 24/7, largely they should continue to compound by 15-17% EBITDA growth story. If you see, Apollo has still not reached to its optimum occupancy utilization level. They are, for the first 9 months, they are at around 65-66% occupancy. Prior to COVID, they were at around 70% kind of occupancy level. So they have still room to scale up their utilization level. Plus the kind of cash flow they are being generating, they are in a very good position to do brownfield or any inorganic opportunities which come across them. So they are also adding some 2,000 beds in the next 3 years on a base of around 8,000 operating beds. So that's a 25% capacity addition they are likely to do. That's on the hospital side. On the pharmacy side, they are also on the offline pharmacy, they are adding 700 to 800 stores. And last 2-3 years, we are clearly seeing that the organized market share has been ramping up and in the retail pharmacy. So that will benefit the players like Apollo Hospital. So that gives us positive on the stock. The key thing to watch out will be the investments in the 24/7. On the stake sale, yes, there has been some delay in the stake sale as the market was not conducive. But over there, what we are seeing is the discounting factor is largely being getting stabilized, and more or less, I think the losses, what they are reporting is largely picked out. And from FY24, I think the losses should come off on the 24/7. I think that is one of the key re-rating candidate in the stock.
Okay, all right, Param. It's good hearing your thoughts. Thanks so much for stopping by and filling us in with your inputs, both on the pharma stocks as well as on the hospital space. But it's almost 9:10, so let's get in our experts back. Sudarshan, what do you have for us at 9:10?
Well, BPCL is a buying opportunity with a stop under 333.
All right, and Mitesh, what about you? Your 9:10 call?
I'll go with a buy on Coromandel Fertilizers. Keep a stop at 932. Look for targets of 975.
Okay, well, let's get the pre-opening rates going now. Tata Motors is your biggest nifty gainer this morning after doubling down on its electric vehicle plans. So there are big expectations over there. Mastech is the other one. Good set of numbers coming through. And that stock, I think, in pre-opening is up almost 5%. That's the last time I checked it. The Equitas Small Finance Bank is another one. They've got the authorized dealer license as well. So that stock is up almost about 1.5%. And a couple of other names that are looking good. You have auto stocks across the board. I think, that Tata Motors rub-off impact. Eicher Motors also in the green, up almost about 0.5%. In any case, this space has been buzzing over the last many days. So looking pretty good over there. Couple of other stocks in the broader markets that perhaps you'd want to look at. Paytm would be interesting this morning. Motilal Oswal has initiated coverage on that stock. We'll talk more about that in greater detail. And a couple of these names like Concor is up almost about 3% That as well is in the news. More on that in a bit. There's an upgrade that has come in there, so we'll focus on that in a bit too. But otherwise, looks like it's going to be a pretty quiet start, really. It was yet another flat close, largely a flat close on Wall Street as well. So our own markets just about quiet. But let's also talk about Tata Communications now. That stock will definitely be in focus this morning. So more on that coming through from the management in a bit. Let's cut across to CNBC Asia for an exclusive conversation with Amur Lakshmi Narayanan, who's the MD and CEO at Tata Communications.
What can you tell us in terms of guidance for the business going forward?
We are very, very pleased with what we have done in terms of the entire year. When we launched our strategy, the Reimagine strategy 3 years ago, we talked about our ambition for a double-digit growth, moving the margins from what it was at 15-16% to a 23 to 25%, a ROCE that was at 8% to a 25% plus company. So today, after 3 years, what we are seeing is a company with a 28% ROCE, a margin, an EBITDA margin operating at 23 to 25% range. And finally, for 3 quarters in a row, we have delivered a double-digit growth, and for a full year, a 10.3% growth, and an all-time high in profits and free cash flow. So we are very, very pleased with where we are. In terms of your question on how the future holds for us, obviously we don't give specific guidance, but we are very, very thrilled and excited about how the company is taking shape as a digital fabric. We are very pleased about the funnel that we've been able to add across all customers, both in India as well as internationally, as well as the orders that we've been booking in the last few quarters.
This is a time when, especially given the outlook economically looking weak, and not just globally, but in India as well. I know India on a relative basis, of course, will stand out because of its overall growth numbers, but people are buckling up. And I wonder, what is the strategy at Tata Communications to really weather the storm and ride over a potential slowdown? Albeit, again, like I said, it may not be really recessionary, but it may be an environment where things might look tough from a revenue standpoint.
Sure. I think barring one market for us internationally, all the markets have been firing in all cylinders, if I may say so. All posting in excess of 15-16% growth. If you look at our Asia Pac market or our European market, they have been growing at high teens last year. In terms of the macro conditions that you pointed out, we appeal to both the cost side of the equation and the revenue side of the equation for our customers with our enhanced products. We would like to think for the next 2 years, customers are going to focus more on cost-led transformations that also delivers better experience for their customers. And there are a number of examples for a very large bank in Asia Pacific, for example. We've been able to replace all their connectivity, which was a high-priced private circuits, to an internet-based using our IZO WAN that delivers predictable SLA-based solutions for them. So it is, and it's completely transformed how they are connected to their applications, to the cloud and to the data centers. So we believe cost-led transformations will take prominence, and our offer that we have globally been able to transform many organizations to cut down cost up to the tune of 20-25% or sometimes even more will definitely appeal going forward.
Right, but when you're looking at large-scale connectivity and laying out fiber optics and essentially building that communications channel, what are the plans? I mean, are you scaling back on capex at this point in time? Are you revising, rethinking your rollout?
Not really. I think we are investing in all the infrastructure. Whether it's fiber, we are going to be rolling out a new edge solution called Cloud Light, and that's going to be all over the world. For our media solution, for example, they're already using our edge solutions across the world, through which we deliver events like Formula One and Formula E, for example. So we are investing on infrastructure because that forms a foundation for our digital fabric on which we build everything else on top, right?
Okay, that's Tata Communications, but here goes the market. Here's the first tick on the index, up almost 20 odd points on the Nifty. The mid-cap index is flat with a bit of a positive bias. The bank Nifty is also trading with a bit of a positive bias. The advanced decline ratio is good though. So the market opening, you'd have to say, is not bad, not good, just very, very quiet. What's piling on the gains this morning? Tata Motors is up almost about 0.5%. It has M&M for company, Eicher Motors as well. So auto stocks are doing pretty well. Adani Ports is trending higher. Ultratech Cements is up almost about 0.6%. A couple of other names like Titan continue to move up, after the news flow yesterday. Asian Paints is in the green as well. Grasim, Bajaj Finserv, ITC has been trending higher, so that one is in the green too. What's dragging the market this morning is a couple of these names from the pharma space. So Divi's is under a bit of pressure. Apollo Hospitals is down. Cipla is down 0.3%. And then you have IT. So Infosys is dragging its feet a tad bit, down 0.3%. And a couple of other IT names as well, just about flatlining. Wipro is absolutely flat as we speak. Let's take a look at HCL Tech. Comes out with its numbers post 5 p.m. in the evening. So that one ahead of its numbers is very quiet with a bit of a downtake. In the broader markets, ICICI Securities is the one that's taking a huge knock this morning, down almost 6% post its numbers. Looked pretty ugly, the earnings, so the stock as well, ICICI Securities, is now down in the red, 5% knockdown on that one. But otherwise, you'd have to say, barring a few result reactions which look exaggerated, Mastech on the upside, ICICI Securities on the downside, the market is very, very quiet, just range-bound, marking time around that 17,600 level.
Well, that's right, Sonia. But let's focus on a couple of stocks on the broader markets. NBCC, that's up closer around 3%. They've secured a project worth around 200 crores from PWD, Puducherry. So that stock is one of the outperformers today. Concord is reacting to the Goldman Sachs report out there. They're fairly positive on the stock at current valuation, so that's up closer around 2% odd. Amy Organics, the stock has seen a good run in the last few days. Now they want to raise some money, so the street is wondering about who are they going to be raising the money from and why are they raising that money. For the time being, the stock is as flat as can be. Let's pull up HOEC. There are a couple of news points coming in there. The BAT field, the repair and commissioning has been completed. Now they are testing gas production out there, and that's why the street has taken that. Though the Court of Appeal of Malaysia, they have dismissed an appeal. But I think because, the BAT field, the repair and commissioning has been completed, so the street is taking it positively. Mastech reacting positively to its numbers. Tata Communications, we just heard the management who said that they are pretty satisfied with the numbers. The street isn't though. The stock is down close to 100%. And ICICI Securities as well. In fact, Tata Communications now from the day's low. I think the street was anticipating a weak set of numbers. It's recovered close to 3% from the low point of the day. So good going on that one. ICICI Securities as well. The numbers, I think, a little bit subdued. Let's see what the initial reaction is. It's down close to around 5%. So clearly, that one's getting a big hit. Surabhi told us earlier that these numbers were disappointing and the stock is down 5% odd. Prashant.
All right, Nigel, 16 points, 17 points higher on the Nifty, 17,634. So, there's a bit of an uptick which has come through in the last, a minute and a half or so of trade. But this is still very much in flat zone. Just pull up the Nifty IT index, which is, by the way, I think what has led this bounce higher that we are starting to see. So, we got a open which was, higher, then there was a sell-off, and then the IT index is recovered. It's up about 0.25% or so. So I think that is the large sector which is causing this move for now. 31 points on the Nifty is what we have. A few other names in the broader space. Container Corporation should come up on your screen. It's the largest volume traded stock which is there right now. It's up 3%. Concall. Mastec, of course, we've been highlighting on the back of results, reacting. Lemon Tree is another one, 2.5% higher on Lemon Tree. Stocks at about 85. Rice companies, right? Daawat, for example, 4% higher. Volumes are decent. I mean, it doesn't usually come up on the stock board early on, but this morning it is. Indigo Paints, if you can have that up, it's up 6%. 1,135 on Indigo Paints, coming up on fairly decent volumes right now. Mirza International, that's Indigo Paints for you. Look at the volumes, not bad. Mirza International went berserk yesterday. It was, I think, at least in the morning, it was up big time. It's up another 10% right now. So 223 on Mirza International. I think on Monday, stock closed at 35. Stock's at 55 now. So that's a very large move in 3 days flat on Mirza International. Shakti Pumps is up about 4.5%. 455 on Shakti Pumps. And I can go down the list and then kind of volumes start to disappear a little bit. There's something called Asian Tiles, which is up 3.5% as well on decent-sized volumes for this time of the day. So that's what's doing well in terms of broader markets. On the downside, Gland Pharma comes up with large volumes. It's recovered a little bit. I think from the open, it was down 2%. But I think Gland is now off the lows. And there is Apollo Hospitals, which is the number 2 in terms of volumes. It's a 1.25% cut on Apollo Hospitals. Stock's been under pressure all through this week. I think for the week, it's already down about 3.5% or so. And then there is Divi's, which we highlighted, I think, earlier, which is down about 1.5% as well. Actually, I can spot Cipla, Varun Beverages, ISEC we mentioned, PVR, etc., which are lower as well. Piramal Pharma closed with gains yesterday, but it's starting 1.5% lower. Piramal Pharma at about 76 or so. Not fairly decent volumes right now. The Nifty is up 56 points now. So, we got a bit of a dip, but for now it's been bought into, and it's a decent looking screen, at least on the Nifty, which is up 50 points. Dheeraj Agarwal is co-head equities at Ambit Capital. He's joining us now to take some questions. Dheeraj, good to have you with us here. Thank you very much for your time. We've had a decent move, 1,000 points or so from the lows of March. What next in the medium term is the question. What is your own assessment? Markets in the last couple of days have also become quite very quiet, not just here, but globally as well. But directionally, how do you see things?
So I've said this, I think, a few times before on the channel that we see this still as a range-bound market. Not too much of upside, not too much of downside. And every time the market makes a move, like you said, 1,000 points from the low, it suddenly appears to be very bullish. It appears sentimentally that we can possibly take out the previous highs and keep roaring away. But then some disappointments creep in, and vice versa. When it falls, it looks like the world is coming to an end. But that's also not the correct picture. We see the market continue to range trade for a while more.
Okay, the market could continue to trade in a range for a while more. What are we looking at in terms of individual sectors, Dheeraj? There's a lot happening now. Autos have come back in a big way. Technology has taken a backseat. Banks continue to be overowned. In terms of a sectoral allocation, what's the best bet?
So, in some senses, sectors also rotating within a trading market, right? But one very important phenomenon of the last few months, the last couple of months especially, is the crash in the WPI index. And now WPI is almost 450 basis points below CPI, which basically means that the huge headwinds that we saw in a number of sectors last year in 2022 and parts of 21 in terms of margin headwinds, because the input costs were rising faster than companies' ability to pass on the price increases is now reversing. For a number of sectors, with WPI now being 450 basis points below CPI, the input cost is now softening, whereas people are not cutting the end product prices fast enough. So a few sectors will see a positive margin bump up going forward, which could be the sectors and which could outperform. So autos, as you mentioned, is one of them, which benefits actually from WPI trading below CPI. A number of other consumer-facing sectors, including discretionary or FMCG, would see some margin boost in the next few quarters. And these sectors could be, from a tactical point of view, 6 to 12 months, could be relative outperformers. Banks are trudging along. I think, as you rightly said, they are over-owned at this point, but nothing negative out there. Results are going to be fine, so they'll probably just trudge along.
All right. Hi, Dheeraj. Good morning. Thanks so much for joining in. You know, the last time you joined in, we discussed that within sectors as well, there'll be themes that will do well. I think we spoke about Mahindra CIE, one of those stocks that were relative outperformers. And we also discussed, banking name SBI. If it corrected from the top, then it's giving you a good entry opportunity. Any stocks that y'all will be looking to add in this recent fall that we saw? We've seen a good recovery, but any such names that you could share with us?
So, usually I don't go deeper into individual stock levels, but within the banking sector, we like Axis, ICICI and SBI, Axis, SBI and ICICI in that order. Autos, our top picks are at this point iShares, Tata Motors, etc. So, that's the whole drift. Markets will continue to range trade between roughly 16,000 and roughly 19,000. Sectors would see sharp rotation, as we have seen in the recent past. IT outperformed for almost 6 months, and then suddenly in the last month and a half, they are looking like one of the worst performing sectors, YTD. So it's going to be a tough market, at least for another year or 9 months.
Okay. You said in autos you like Tata Motors and Eicher Motors. You're not looking at any of the rural, the two-wheeler guys, the passenger vehicle makers in the Indian market, something like a Maruti, M&M, Hero. I know some of these stocks have, barely recovered and are still struggling with the rural markets under pressure. But anything that you would buy?
No, I think these two remain our topics. Rural markets, rural economy, there is a lot of optimism creeping in at this point of time. To be fair, rural economy has stopped worsening at this point, but will there be a strong recovery going forward? We are slightly circumspect. Talking about tractors specifically, tractors have seen almost 2.5 years, a very strong upcycle. And it is a cyclical sector. It's never happened in the past that we have seen a strong upcycle in tractors for 3 or 4 years in a row. Maruti has its own other challenges. It, by and large, remains a tactical trading play, 10-15% move up and down. So the short answer is no, we prefer Maruti. We prefer Tata Motors and iShares in this space.
Dheeraj, on Tata Motors, it's a massive commitment, right? 15 billion pounds over the next 5 years. Will it kind of reignite concerns around free cash flow, given the commitment that they are making?
It's a little bit of a chicken and egg, because one of the longer term concerns in Tata Motors always has been that while they're doing well in the short run, in the long run, do they have the product portfolio and the models and new technology to be able to stay relevant on a 5 or 10 year time frame? So there's always a little bit of what's the right thing to do, just focus hard on free cash flow and not do any product development But I think what the company is doing at this point of time is more intelligent capital allocation rather than just spraying capital all over the place. And that's one mantra which the company has followed for a while. This year and the next year, the strong FCF generation will show up on stock price performance. Longer term, the JLR portfolio has to address the concerns on the entire product relevance from a 5 or 10 year point of view.
Dheeraj, let's talk about the hottest sector for the last 10 days or so, the IT space. Some believe that this kind of a lull or this kind of uncertainty is providing a perfect entry opportunity, and they are very high quality names as well. Would you be in that camp, or would you say the pain is just starting? We have not yet seen that full-blown recession in the United States, which everyone's anticipating, and you'd rather sit on the sidelines and better opportunities will come to enter IT stocks?
I think we'll get better entry points. And just to soften some of the adjectives that you've used, whether there's a full-blown recession in the US or whether there is a mild recession or mild slowdown in the US is, I think, not that much of a debate at this point of time. But one thing which is looking very, very clear is there are budget cuts. Companies, especially in BFSI, retail communication, are scaling back spends. And that will impact IT companies' growth going forward. We have already seen signs of that in this quarter results, which has come so far. This will only accelerate going forward. So just to look at the growth numbers versus valuations, IT sector growth is moderating now to almost pre-COVID levels, maybe even slightly lower than pre-COVID levels. And the valuations are still trading 20-25% premium to pre-COVID levels. Between 15 and 18, 19, IT sector even traded at a discount to Nifty for a while. It's still at a premium of 15-17% to Nifty at this point. So the entire valuation readjustment to the growth moderation has not yet happened. This will play out over the next 2 or 3 quarters, perhaps, maybe 2 quarters if it's fast. So there will be better entry points. I mean, they are fabulous companies, free cash flow generating, cash rich, very well governed, undoubtedly. But it's simply equilibrium between growth and valuation that one is concerned about.
Dheeraj, I don't know if you've been following the troubles at Blinkit recently. Been all over the news. I don't know if any read-through for a name like Zomato, because I mean, in that space, when people ask, well, do you like anything in the new age companies? Zomato constantly comes up as perhaps the number one choice for many, because many see as a clear use case for it. We all use it, food delivery apps. So that is there. But any read-through from what we've seen at Blinkit?
I mean, just a quick comment. I haven't actually thought through it deeply, but any reduction in capital allocation to Blinkit is actually positive for Zomato. So okay. I think the core food delivery business is fantastic. Grocery business is very, very challenging and could suck in a lot of capital. So it may be unfortunate at some level, but to some extent, reduction in capital allocation to that space would be positive.
Okay, we will end the discussion on that note. Dheeraj, thanks a lot. Pleasure speaking with you. And by the way, the market is also picking up pace. So perhaps you're that good luck charm that the market needed at this point. 60 points higher now on the index, the Nifty getting above that, trying to get above that 17,700 mark, led largely by heavyweights like L&T, there's TCS, ITC, HDFC Bank. So not a bad opening. Let's see if the market can build on to this. But one segment that is struggling a bit is the electric vehicle space, and I'll tell you why. The Indian government is now not in favor of extending the electric vehicle subsidy scheme beyond March 2024. Remember, the subsidy scheme was what was keeping, that incentive going, and that the decision making was a bit easier since subsidies were given both to EV two-wheelers and three-wheelers. However, now final decision has not been taken yet. EV subsidies to the tune of 1,200 crores have actually been on hold for more than 13 electric vehicle players for close to a year now. So we'll get a discussion going on what this means for the industry. Parikshit Luthra, first up, gets us more on the multiple challenges that are confronting the electric vehicle sector now. Parikshit, over to you.
Top government sources telling us there is no proposal under consideration as of now to extend the FAME subsidy scheme beyond March 2024. A final decision is awaited. At the same time, EV subsidies to the tune of 1,200 crores have been on hold for more than a year now, and this is leading to a shortfall in sales. So where do things stand as of now? In the month of March, Hero Electric and Okinawa have seen a drop in sales in the range of 48% on a year-on-year basis, and certain others have seen a 42% drop in sales. Industry body SMEV says there has been a 25% shortfall in targets since the festive season last year. One of the reasons for this is that subsidies for 13 companies have been on hold since May last year due to a probe relating to alleged misappropriation of subsidies. subsidies to the tune of 1,200 crores have been on hold. Now, the SMEV industry body says subsidies are on hold for companies representing at least 95% of the market. And subsidies for 4 other EV companies like TVS, Ola, Ather, Hero MotoCorp have been on hold since March this year, pending inquiry into complaints of subsidies being availed on products costing more than the eligibility limit of 1.5 lakhs as per the FAME scheme. Now, all these 4 companies are in touch with the government. Ather, for one, has slashed prices of its top variant to 1.45 lakhs to meet the FAME criteria. Industry sources say if subsidies continue to be on hold, then there could be a demand softening and drop in sales as well. But here's what could really impact the industry, and that is the government saying there is no proposal as of now to extend the FAME scheme beyond March 2024. A final decision, however, is awaited.
Okay, thanks a lot for that. We find out more on this with Gagan Sindhu, who's the Director at Council on Energy Environment at Water Centre for Energy Finance, and Himang Jani, the Retail Equity Strategist at Motilal Oswal Financial Services. We also have Mitul Shah, who's the Head Research at Reliance Securities, joining in. So, a full house here. Gentlemen, thanks a lot for joining us. First, I want to start with Gagan. If you put the numbers together, right, the EV sales in FY23 went up 187%. Of course, this is on a low base. But now, this probe to end the FAME subsidies, do you think it could dampen demand for the electric vehicle sector? Because as my colleague Parikshit was just mentioning, 1,200 crores of subsidies have already been held back to almost 13 players, including the likes of Hero Electric, Okinawa. If these subsidies are withdrawn or put to an end, what kind of impact do you think it would have on demand, Gagan?
Sure. Thanks for that. So without getting into the specifics of individual companies, let me just say that there's several kinds of incentives available for consumers who are looking to buy EVs in India, right? So there's a national level FAME subsidy, there's a GST incentive, and there's also state level incentive. Not every state has state level incentives, many do. So all three really combine to I would say, inverse the inherent price disadvantage that EVs face at the time of purchase, to make EVs more advantageous, to make EVs even more competitively priced versus ICEs. So, it's not just one set of subsidies that matter, it's all 3 sets of subsidies that actually drive that attractiveness of EVs.
All right. I just wanted to follow up on that point. In light of this, do you think that entire EV adoption theme that we're talking about, I think we have a target over here of close to 80% EV penetration. Do you think that this target is realistic, or do you think it gets pushed back a little bit, Mr. Sindhu?
So I think that the number you're referring to is perhaps not a stated target per se, but it's the electric mobility vision that Niti Aayog had, right? Yes. So one of the things that I think India can actually do with is an official EV target. So, we have one for renewable energy. We also have one for green hydrogen. So I think an official EV target, which gives direction, which gives market certainty, which shows where the ambition is very, very important.
But, the big question also is, can the industry manage without subsidies, right, after March 2024? I guess my colleague Nigel was also coming to that point, that will the adoption become much slower? Will margins start to get impacted? Because as we've been hearing, a lot of these companies are going big in the EV space. I mean, we just heard about JLR investing £15 billion. Of course, that's for the global EV market, but back home in India as well, a lot of companies are putting plants on board, going big on investments. Now, if these subsidies are put on hold, do you think margins could get impacted, and can EV adoption slow down? Mitul, you've been tracking this space closely, so I wanted your thoughts on this.
Yes, this kind of a support from government is very essential. I would like to quote here one very interesting example of Chinese EV industry, where this government gave support for more than 10 years. Then the industry became healthy in terms of size as well as profitability. So this is a very initial years wherein nearly 80% of the players are like a startup, or technology support along with the financial support is essential for them. Barring few big existing two-wheeler players, most of nearly more than 80% are kind of a startup. So they are completely relying on this support from government. So withdrawal of this support will certainly pose their hold, and they'll put a situation will become tougher for them. Because as you all know, that adoption of EV still, as of now, is very negligible, just in terms of a low single-digit penetration. So we need to go far away from this, and for that, maybe in other form or extension of FAME or in other terms also, support is very essential for next few years for the industry.
Absolutely. Hemang, come in on this. I mean, China and other developed economies are far ahead in terms of EV adoption, and that's also largely because of the government support that, you know, some of these markets like China have got for more than a decade. What do you think the government needs to do here, A? And B, you know, for now, the government is not considering any extension to the FAME subsidies. But do you expect the incentives to be completely pulled off, or there could be some incentives to, you know, pockets like, say, buses? EV buses are picking up in a big way, or even EV two-wheelers. Your thoughts?
So, good morning, Sonia. Thanks for the opportunity. I think clearly the way things have gone as far as EV is concerned, particularly when you look at the cars, India is a small car market and a price-sensitive market. And when you look at the cars which are being offered, you know, Tata Motors and clutch of other companies, the pricing of these cars is slightly on a higher side for the EV product. Same is the case with two-wheelers and for buses also. So unless the government, gives some sort of support to the manufacturers and to the final consumer in terms of this pricing advantage, the growth will surely not be, like what we've seen in China and many other parts. Also, Sonia, what is important is that the entire ecosystem, the charging stations, that infrastructure requires a lot of money, and only when the government gives certain support will it be possible to have that. So without a significant support and a commitment from the government, the entire growth that one is really looking at could actually slow down.
Okay. So, you know, I wanted to come in on two-wheelers a little more because a lot of these companies are putting up plants. They're going big on the EV space. So, Mitul, let me get you in on this. How important do you think is the FAME subsidy for sustained two-wheeler adoption? And if the subsidy is withdrawn, if there's no extension, then what do you think the impact would be on the working capital? Would there be a lot of working capital pressure for some of these companies like, say, Bajaj Auto? TVS is going big in the EV space as well. What do you think the impact would be?
Yes, Sonia, as you pointed out rightly earlier, that 1,200 crore kind of a amount is stuck up with the government for these players, and working capital is entirely depend on this support from government. So in case of two-wheelers, these large players like whether it's a Bajaj or Hero or TVS, they would probably still able to survive because their profitability is not depending on EV. Their IC engine business is able to fulfill all the requirement. But for other players like whether it's Okinawa or even Ola and all those type of players, where the support and financial strength is not very strong for them, so government withdrawing this benefit will impact their performance to greater extent. May not be at least to these top players, but small and medium-sized players within two-wheeler space will have a more impact compared to four-wheeler, where all the players are having a big pocket and they are able to support their capex without any external support. But two-wheeler is the different situation.
Got it. That's an important point you make, that some of these larger players, they won't have a major hit perhaps on profitability because EVs is not a very big part of their business up until now. So yes, they could take a hit, but it won't hit operational performance too much. Gagan, I wanted you to come in on the inflection point, because the bigger question is this, right? Have EVs across the board, two-wheelers, four-wheelers, reached an inflection point such that even if the prices go up by 50,000-60,000 rupees, for example, people will still go ahead and buy? So even if the FAME subsidies are withdrawn, which at some point it should be, demand may not get hit. Do you think that inflection point has been reached?
So, last year we had more than 1 million EVs registered in India. But if you scratch the surface, the bulk of them, more than 50%, 50 to 55% of them are actually E2-wheelers, with most of the balance being E3-wheelers. So really not anywhere when it comes to the other categories. The second point is, Sonia, you said inflection point. That's a tough one to answer. But what I can tell you is we've sort of seen evidence that subsidies do matter. And we've seen evidence that higher subsidies do translate into higher volumes. Let me just give you an example. So in a recent study that CEW conducted, we sort of tracked not just the FAME national level subsidy but the GST, but also state level subsidies. And we particularly looked at states which had EV subsidies versus or EV incentives versus states which did not have EV incentives. And we found that for those states with those incentives, they actually saw volume growth which was 2x better than states without EV incentives. And then we sort of looked a bit deeper into e-two-wheelers because that's really where the bulk of volumes are coming from. And we saw that states with higher incentives, actually saw volume growth which was almost 5x better than states with lower incentives. So what I will say is clearly, incentives, subsidies do matter. What's the right time to wean oneself away from that? Difficult one to say.
Okay, gentlemen, appreciate your thoughts. Thanks a lot for joining in and helping us assess what would happen to the sector once, if and when the FAME subsidies are withdrawn. What we understand is that the FAME subsidies may not be ended entirely. For some pockets like, say, buses, commercial vehicles, or even some electric two-wheelers, subsidies on EVs may still continue. But that is, of course, only conjecture at the moment. There's no confirmation. As of now, 1,200 crores worth of EV subsidies have been put on hold, and that has impacted the industry quite a bit. But that's not stopping a lot of players from investing in this space in a big way. We just heard Tata Motors-owned luxury car maker JLR has unveiled a 5-year plan to electrify its fleet. The company will be investing £15 billion over the next 5 years to accelerate their EV transition. They also aim to launch the first all-electric Range Rover in 2025. CNBC TV18 Sanjay Suri joins us with more on that. Sanjay, would you elaborate on what the electric vehicle strategy is?
JLR has spelled out its reimagined strategy for the next several years, and it's pointing the way of all electric, all luxury, very green, very clean. The company plans to invest £15 billion over the next 5 years in electric propulsion, with plans eventually to go carbon neutral by 2039. The Range Rover is due to go all electric pretty soon. The company is taking orders from as early as autumn this year for an all-electric Range Rover to go on the streets in 2025. The engine plant at Wolverhampton is switching to electric propulsion production, and JLR clearly is headed the way of sourcing battery packs and cells through the Tata plant due to be built in Europe. Sales from Britain alone have topped £12 billion a year currently and growing steadily. The company is planning to build on that in a luxurious sort of way. The company is sticking to the high end, none of those rough and ready Land Rovers of the old kind. By way of design, the company is headed the way of simple, clean lines, keeping it light, no crowded buttons. That matters for looks, of course, but it matters for battery life. JLR is working on a 700-kilometer range for the 2025 Range Rover with a 320-kilometer charge in 15 minutes. JLR clearly plans to lead the change in this fast-changing world of driving.
All right, that's a large investment which Tata Motors JLR is laying out, £15 billion over the next 5 years, as Sanjay said. Sanjay, thanks very much for that. Well, we'll take a quick commercial break here. The Soam Distillery stock is up 7%, 7.5%. It's done very well over the last 1 month. Actually, this year it's up 40%. We speak with the management when we come back. J.K. Arora of Soam Distilleries talks to us about the demand trends, the quarter which has gone by, and of course, commissioning of new capacity as well. Later in our special segment, Quarter Se Quarter Tak, Nigel will analyze expectations from the cement sector in the fourth quarter. Mahesh Bhadang of Centrum Broking will also join in to discuss expectations from the space.